Visa is on our updated 2022 watch list. These are 30 companies that we are getting ready to buy as the market crashes. Visa Inc. serves more than 15,000 financial institutions across more than 200 countries. The company operates VisaNet, which is the world's largest payment system. And during the fiscal year of 2021, Visa processed approximately 165 billion payment transactions. On top of that, there are very strong barriers to entry that protect Visa from potential threats. But none of that matters if we don't buy these shares at the right price. So I'm going to conduct a quick company health check and run the numbers to do an intrinsic value calculation to determine our strike price for Visa. We've got a lot to cover today, so let's dive in. As value investors, we believe that when you buy shares of a company, you are not just buying some random stocks that are numbers on a computer screen, but instead you are becoming a partial owner of that business. Therefore, we always start by looking at the company's story and financial fundamentals. And this is especially important when we think that there may be an economic downturn in the near future, just like we do right now. When it comes to the story of the business, in order for us to even consider investing in a company, it needs to be a business that we understand, a business with honest and capable management, and a business that has strong, durable competitive advantages. These are all things that will keep the business healthy and protect our investment. Now, we have done a good amount of research into Visa's story, and those boxes are checked for us. If you want to do your own research so that you can decide how you feel about Visa's story, I'll link some good resources for you in the description. Okay, we can now start to work through our valuation cheat sheet, and this is a custom spreadsheet that Chris and I made that suits our specific process. The numbers that you're going to see in this video have been sourced from Morningstar.com, where Chris and I have a subscription that cost us about $34 a month, and it allows us to access 10 years worth of collated data on the company. There are several paid options for data providers, so you don't have to use Morningstar if you don't want to, and you can always do the steps that I'm describing even without a paid subscription. All the data is available on the SEC Edgar website for free. We also recently got a great suggestion from one of our viewers that you can use your public library to access value line reports for free. You may have to do a lot more digging to find the numbers that we're looking for, but it can be done if you're willing to put in the extra effort. Regardless of which data source you choose to use, the principles of our process are the same. The guidelines for the health check and the method for figuring out the strike price aren't affected by where you get your data, as long as you get it from a reliable source. The first tab we're on is the company health check, and here we are looking at the financial fundamentals of the business. These are facts, numbers that are publicly available, which are going to tell us a lot about how well the company's management allocates capital, the potential growth of the business, and how well they preserve shareholder value. And the first thing that we want to understand is the company's ability to pay down debt by looking at how many years of free cash flow it would take to pay off their total non-current liabilities. The lower the number, the better, but as a rule of thumb, we really like it when a company can pay off this debt in 5 years or less using their free cash flow. And if they can't, it's our cue that we need to dig in deeper. Debt can kill a company, especially if their cash flow is negatively impacted, like it very well can be during a recession. Visa's total non-current liabilities for 2021 is $29.57 billion. When it comes to their free cash flow, I found that last year they had approximately $14.5 billion, and in the trailing 12 months, that number was approximately $15.3 billion. Normally, I would use whichever of these numbers is smaller. However, because we are likely facing an economic recession, I am being extra conservative. So in my cheat sheet, I'm actually going to underestimate a bit, and I'm going to use $14 billion as our conservative assumption for free cash flow for the rest of this valuation. The lower number also gives me some cushion if spending decreases negatively impact Visa's cash flow. And you're going to see me apply this conservative approach throughout this video and all of the other valuations that we're sharing as part of our updated watch list series. When we divide $29.57 billion by the $14 billion, it tells us that it would take Visa a little more than 2 years of free cash flow to pay off their long-term debt. That's actually a great ratio, and it gives us our first check. Okay, moving on, we want to see if they have a strong return on invested capital, or ROIC. This is the cash that they earn on their debt and equity, and generally we like to see something over 10% because it indicates to us that the company's leadership is good at allocating capital. In the trailing 12 months, the ROIC for Visa was at 25.9, and looking back over the last 10 years, we can see that Visa has achieved well over 10% ROIC in all but one of those years. I'm happy with that, and that gives us our second check. Now let's talk about growth. We like to see their revenue, net income, and most importantly, cash flow in a general upward trend. So in my table, you can see that I have entered the data for 10 years ago and for last year. Across all three metrics, they have had growth. Another big check. Next, we will take a look at their shares outstanding to make sure that they are not diluting the shareholder. Unlike a stock split, issuing new shares actually reduces shareholder value. It's usually done by companies needing to bring on cash to continue operations or grow the company, and we prefer to invest in companies whose cash flow can do this. And we also take it as a positive sign when companies are actually reducing their shares outstanding over time. 10 years ago, Visa's shares outstanding were 2.71 billion, and in the TTM, they are at 2.17 billion. So Visa has been buying back shares over the last 10 years with an overall reduction of 20%. Excellent. That gives us another check. And the last metric that we are going to look at is the safety of the dividend, which for Visa is currently yielding around 0.7%. We want to see how comfortably they can pay out these dividends, and to do this, we're going to compare the amount they pay with the same free cash flow number we used earlier. Currently, Visa is expected to pay out a total of approximately $3.26 billion in dividends this year. When we compare this against the $14 billion, we see that they are using about 23% to pay these dividends. So I'd say that their dividend is very secure, and that gives us our final check. Looking at our summary table, we can see that Visa has a clean bill of health based on the metrics that we've used. And something that I find very useful about this new version of our cheat sheet is that we programmed Excel to auto-populate green and red based on our guidelines. So once we're done entering in all of our health check data, we will have a very nice visual summary. Okay, here's where the real work begins. Before we can do the final strike price calculation, we have to decide what number we're going to use for the expected growth rate of the company. I would argue that the growth rate is probably the single most important number that we're going to plug into our valuation calculation, and it's also the most subjective. When Chris and I first started investing, this was a concept that took us a while to truly understand because initially we thought that the expected growth rate could just be determined objectively using a set formula to get a definitive number. It wasn't until we had been doing this for a while that we really understood that whatever number anybody gives you for projected growth rate, it's just an educated guess. Essentially, we are trying to make a prediction on how we think the company is going to grow over the next 10 years. Nobody has a crystal ball, so we're all just doing our best to make an informed decision. Different investors have different ways of estimating the expected growth rate. Because it's so important, Chris and I like to do a little extra work here. We like to compare three numbers to form our baseline, and then we actually compare this with some additional detailed research in order to finalize our expected growth rate. In our process, we always start by looking back on the past 10 years to try to get an idea of how the company might perform in the future. So I'm now on to the second tab of our cheat sheet, and we calculate the historic growth rate in two different ways based on historical data for the free cash flow of the company. As a starting point for both methods, we plug data in for the free cash flow for the past 10 years, and for Visa, it looks like this. To get our first result, we have applied the compound annual growth rate formula, which you can see here on the screen, and here you can see what this formula looks like embedded into our Excel sheet. Using the CAGR formula, we get a growth rate of 13.5%. I think this is a good starting point for figuring out the historical growth rate, but the problem with this method is that it only compares year 1 and year 10, and it ignores all of the numbers in between. So if you are only going to use this method, just make sure that the numbers you plug in are not outliers, because if they are, it could really give you an inaccurate idea about the company's growth. And this leads me to method number 2 that we like to use for calculating the growth rate, and that is to plot it in a chart. We use the same 10-year table for free cash flow to create a scatter plot chart with an exponential trend line that shows the equation. From here, all you have to do is look at the exponent of the equation and move the decimal places over 2 spaces to the right, and that gives you your percentage. And this method gives us a result of about 15.2%. Chris and I really like making this chart because we feel it is more complete and provides a very good visual representation of how the company has performed over the past decade. And it makes it very easy for us to see if there are any outliers. And if they are, it actually triggers us to do some extra research to try to figure out what happened during that outlier year. Now, an important side note is that I want you to remember that the charting methodology only works if all of your numbers are positive, so please watch out for that. Now, to get our third layer of assurance, I just want to head over to Yahoo Finance and check out what the analysts are predicting for the growth of the company over the next 5 years. And I can see that the average analyst is saying about 18.2%. Okay, so let's look at our summary. We have 13.5%, 15.2%, and 18.2%. Ultimately, I decided to use a slightly more conservative number than all of these results. I'm going to go with 12.5%. This lower growth rate is supported by some of our additional research into the company, and also this more conservative number kind of gives me a cushion in case the cash flow is negatively affected by an economic recession in which people are actually spending less money. Okay, before we move on to the next step, I just want to say that it's really important to remember that past performance is no guarantee of future results. So it's really important that you add narrative to the story that the numbers are telling you and you back it up with your own research. And the way that you do this is by reading the annual report, listening in on earnings calls, watching interviews that the management gives. You want to try to understand the company's competitors, their products, their services. Essentially, you want to keep researching until you stop learning new things about the company. All right, we are finally ready to start the valuation process and determine our strike price. This process is essentially our attempt to predict future value to decide what we're willing to pay today for those shares. It involves doing some calculations using key numbers and making some informed judgments. And it is so important to determine the value of a stock before you invest in it, because that's what's going to protect your investment for the long term. Remember, price is what you pay and value is what you get, and we want to know the value of a company before we invest in it. There are several ways to do an intrinsic valuation of a company. Chris and I prefer using the discounted cash flow method, so that is the methodology that we're going to use to value Visa today, and I'm going to use a terminal multiple after 10 years. This means that we are going to forecast the cash flow for each of the next 10 years, and we will assume that we will sell the company and collect a lump sum. Then all of these cash flows will be discounted back to a value of today by our desired rate of return. This methodology requires 5 key numbers: shares outstanding, free cash flow, expected 10-year growth rate, free cash flow multiple in 10 years, and your desired rate of return. All right, let's plug in the easy stuff first. We already know a few of these numbers from our health check and the work we just did to determine our growth rate, so let's put them in the spreadsheet now. Shares outstanding, 2.17 billion, FCF conservative assumption, 14 billion, and expected 10-year growth rate, we're going to go with 12.5%. All right, now we are on to our fourth key number, which is the free cash flow multiple in 10 years. And what we are essentially trying to determine here is the free cash flow multiple that we assume Visa is going to have in 10 years when we're also assuming that we will sell the business. For this, I'm heading over to macrotrends.net to look at Visa's historic price to free cash flow. And looking at the historic numbers on Macrotrends, I can see that it has averaged more than 40 for the last decade. Now, if you guys have watched my videos before, you know that my rule of thumb is that 15 is as high as I'll ever use for a multiple. Now, if I think that the company has a lot of room to grow, I might consider going a little bit higher. Now, with Visa, I actually do think that it still has plenty of room to grow, so I'm going to use a multiple of 18 for this valuation. I think that is reasonable and still on the conservative side, considering Visa's historic valuations. Now we need to decide what desired rate of return we want to have for this investment, and this is completely subjective because ultimately you're deciding how much of a return you want to get. And in this case, I'm going to use 15%, and that's typically our go-to rate. For some of you, it might seem high, for some it might seem low. The reason why we like 15% is because we know that if we were to just invest in the S&P, that historical return rates are around 10%. So since we are taking on the extra risk and also doing so much extra work in order to invest in individual companies, we want a return that is higher than 10%. This is what our cheat sheet is looking like with our 5 key numbers. And with this, we can now do our valuation. And remember, we are using the discounted cash flow method. And this means that we are using this method to estimate the value of our investment based on its expected future cash flows. A discounted cash flow analysis attempts to figure out the value of an investment today based on projections of how much money it's going to generate in the future. So off to the side, we've made a table labeled from year 0 to 10, and I have year 10 listed twice because that's our terminal year, and that's when we're assuming that we will sell the business. In this row, we are creating an estimate of Visa's future free cash flows. So we start off by entering the FCF value of 14 billion, and from here we go down the line to grow the amount from the previous year by our growth rate of 12.5%. Here's what the formula looks like in our cheat sheet. Okay, now remember the second column showing 10 is actually there because this is the year that we assume we will sell the business. So in order to get this number, we use a different calculation. We have to take the free cash flow of year 10 and multiply it by the number we picked for the free cash flow multiple in 10 years, which in this case was 18. And 18 times 45.46 is 818.32. Okay, now we get to work on our bottom row, which is where we figure out today's value using the present value formula, which we have also embedded into our spreadsheet. Once we apply the formula, here are what the results down the line look like. Next, we just need to add up all of these numbers in the second row, and we get a total value of 326.58 billion. And now there is just one more step to figure out our strike price. But before I share our final strike price with you, I just want to give you a friendly reminder that I'm not a financial advisor, and I'm definitely not your financial advisor. The whole purpose of these videos is just to share what we are personally doing, so please don't take them as financial advice. All right, without any more delay, all we have to do now is take 326.58 billion and divide it by the shares outstanding, which in this case is 2.17 billion, and that gives us a price of $150.50. So that's it. Our strike price is $150.50. On the day that I'm filming this, Visa is trading at right around $212. So it's overvalued for us at this time, but we are going to continue to watch it and be ready to sell put options and buy shares when it's near our strike price. Chris and I firmly believe that there are going to be a lot of excellent investment opportunities popping up in the coming months. So be sure to check out our other valuation videos if you want to stay up to date with what we're doing. Would you invest in Visa? And if so, what's your strike price? Remember, earn more, spend less, and invest the rest, and I'll see you next time.